All right, so now we're going to talk about these four non-controlling interest figures that must be included in the consolidation process and that we have to include when we prepare our consolidation worksheet. And so we're going to deal with this partial acquisition with no control premium only in this chapter. I hate it when they do this. All right, so when you have a non-controlling interest, you have to do everything that we talked about before in Chapter 3, the SADI entries. Plus, you have to add these figures to your worksheet for the non-controlling interest. So you're going to create another column for the non-controlling interest, much like you have in Exhibit 4.6 on page 161. And in there, you're going to add the beginning of current year non-controlling interest balance. You're going to, in that column, list the subsidiary's current year net income for the non-controlling interest. In that column, you're going to list the non-controlling interest's current year dividend payments, their portion. That's going to, again, what you're doing here is you've got the beginning interest of the non-controlling shareholders. To that, you're adding their portion of the subsidiary's current year net income. That adds to their equity in the sub. And then you're going to list their portion of any dividend payments made by the sub. That's going to reduce their share in the sub. And so the sum of those three equals their equity interest in the sub at the end of the year. All right, so we start with an example. Assume that it is the same one that's in the book. Assume that King Company acquires 80% of Pawn Company's 100,000 outstanding shares on January 1, 2014 for $9.75 per share, or a total of $780,000 in cash. And note this is a little different than before, where they're not paying a premium. And so the shares are trading at an average of $9.75 per share before and after the acquisition. So in this case, the non-controlling shareholders' shares are also trading at $9.75 after the acquisition. So and so the total fair value of Pawn to be used initially is the $780 consideration transferred by King plus 975 times the other 10,000 shares. Oh, excuse me, the other 20,000 shares. So 20,000 times 975 equals 195,000. And so that equals 975,000. And so if you look at Exhibit 4-2 in the book, they don't have it here, but note that the book value of Pawn Company, the sub, is $740,000, and the fair value of the net assets and liabilities, well, assets acquired and liabilities assumed is $950,000, so the difference is $210,000. And so we have fair value in excess of book value of $235,000 after you allocate that $235,000 to the fair value of the assets acquired and liabilities assumed. You have a difference, of course, that's not aligned to any of those items. So that's going to be goodwill of $25,000. And again, notice you've got some assets that are indefinite, so you're not going to have any annual excess amortization, and some you do have amortization, some negative amortization in the equipment. And notice you have different years in some of these that aren't indefinite. And so your annual amortization in excess of fair value over book value in the initial years, the first 8 as a matter of fact, is $10,000. Note here at the bottom how we allocate the goodwill. Very simple. 25,000, 80% of that goes to the controlling interest, and the other 20%, or $5,000, simply goes to the non-controlling interest. And so to add to the information, they also give you 2014. Now remember, this acquisition happens on January 1 of 2014, so we're here at 12/31/2015 in this example, and so they give you some more information to round out the picture. 2014 increase in retained earnings for the sub is $70,000. And so 80% of that goes to King Company, $56,000. And if you look at Exhibit 4.4, you see what they've done there. They started out with their acquisition price. Again, they're using the equity method, right? King is. So they start out with their acquisition price for the 80% interest of $780,000. In the prior year, 2014, their portion of the increase in retained earnings of Pawn is $56,000, which is 80% of the $70,000, less their portion of the excess amortization expenses, which is 80% times $10,000. So $8,000. And in the current year, of course, their portion of the $90,000 net income is 80% of that, or $72,000. Then they're going to pick up their excess amortization expense of $8,000. And note also that dividends for the current year, well, for all years, I guess, is $50,000, of which $40,000 are allocated to King. So that's the information you need to round this out. And so what you need to do is look at some of these entries that they've made. They go right to this, which I think is kind of ridiculous. But this is Exhibit 4.5. And again, on page 158, you could definitely figure out the totals here without even using the worksheet. But I guarantee you'll benefit from probably first making the calculations, doing the entries, and including those entries in a consolidated worksheet like this. But if you don't want to do that, if you just want to figure out how you would do this without a worksheet, then look at their example on page 158 all the way to the top, well, to the middle of page 160. You don't need a worksheet, but it would come in handy, I would think. Bottom line is, somehow, some way, you have to figure out what needs to be taken out or put in. All right? So, note in your consolidated worksheet and the consolidation entries that you have, the SAIDE. They're the same entries with a few twists. For example, again, you're going to add if you're going to do the worksheet, add your column, non-controlling interest, and make your entries SAIDE. And so again, the S portion, you're backing out the common stock of pawn. Let's see if they show this. I don't think they do. Well, they do. You're backing out the common stock of pawn. You're backing out the retained earnings of pawn. That should look familiar. Where does this number come from, the 648? Well, this is the book value of 740, if you recall, from Exhibit 4.2 times 80 plus the 56,000 portion of income that King got allocated for in 2014. So 740,000, the book value, original book value of pawn, times 80%, plus 56,000, which is their portion of 2014 income, equals 648. And then this number right here, the 162, if you look at, well, you can see it on page 160 or you can see it on page 162, either one. It's 20% times 810,000 subsidiary book value at 1115. So that's where they came up with that 162,000. And if you think about it, that's, I don't think they did that in here, but that's the parent's book value as of 1115, right? So that's where they came up with those numbers. And then what you're doing here, you're debiting the difference between book value and fair value of the assets acquired and liabilities assumed. So you're adding 60,000 to trademarks, 114 to patented technology. Here, let's see what you're doing there. Oh, well, in the prior year, what you had done there was you had already allowed for $5,000 of the 40 excess, and so this is what's left, the 35,000. You're going to add that to the liability, and then of course you're going to add your goodwill. Equipment is one of those negative amortizations. So in year one, 2014, you negatively amortized 1,000. You started with 10, so you add, well, you're actually subtracting that from equipment, the 9,000. And then, let's see. This number and this number are this is 780. Let's see what it says. Investment in pawn company, 80%. So the 180 is 780 plus 48,000. 2014 income. Remember, 56 minus the 8 minus 648 that you had up here. You started with, and then down here, that actually comes from. Again, page 160 or 162, the calculation of the 20% outside ownership as of 1115. So that's where the 45 comes from. And then, so those are two challenging things. You have to know where the numbers are coming from. And then these are fairly straightforward. Here you're going to eliminate the intra-entity income accrual. Of 64,000. Now, where did that number come from? Well, that's your 72,000, 2015 income attributable to King. Again, if you look at Exhibit 4.4, minus the excess amortization expense. So the income accrual is 72, and then of course their portion of the excess amortization expense is 8,000. So that's where you come up with the 64,000. And of course, of the $50,000 dividends that have been paid, 80% of that is attributable to King, so they have to, in this consolidation entry D, back that out. So investment in pawn company, 40,000, dividends declared, 40,000. And then your consolidation entry E, remember, you in consolidation entry I, you undid your excess amortization expense allocation. So you have to come back in here and re-enter that separately. And then you do your four other things. I don't know if this shows it. No, it doesn't show it, but essentially, if you look at the other four things they do, they, of course, have their column, and the first thing they're going to do is figure out their beginning as of 1/1/15 non-controlling interest in pawn, the balance. And so that number is on page 162. It's the sum of the 20% times the 810,000 subsidiary book value at 1/1/15, the 162,000, plus the 20% of the 225,000 unamortized excess fair value allocation at 1/1/15. And so 162 plus 45 is 207. You're going to put that number in your worksheet there in Exhibit 4.6 down near the bottom. The next thing you're going to do is you're going to determine net income, the non-controlling interest share of net income. In this case, it's $90,000 minus the excess acquisition date fair value amortization, or $80,000 net income adjusted for excess amortizations multiplied by the non-controlling interest percentage, or 20%. So that equals $16,000 net income that's going to be attributable to the non-controlling interest. So again, that goes in on your worksheet, and note there's a few extra lines that are added under consolidated net income. You have net income attributable to the non-controlling interest. And from that, you're going to subtract the non-controlling interests portion of any dividends paid. In this case, dividends, $50,000, $40,000 was paid to the parent. The remaining 10, or 20% of the 50, was paid to the non-controlling interest. And so again, 10,000 dividends reduces the non-controlling interest equity position in the sub. So essentially 16,000 minus 10,000 equals 6 that you're going to add to the non-controlling interest in pawn as of 1/1 to come up with the non-controlling interest in pawn as of 12/31, which is 213,000. So make sure you look at the columns here. This new column called non-controlling interest. Also, there are some new lines in this exhibit. Consolidated net income underneath, net income attributable to non-controlling interest, also net income attributable to King Company. And then you have your 2 lines down there, your non-controlling interest in pawn as of beginning of year, and then your non-controlling interest in pawn at the end of the year. So, and then, you know, essentially you can take this worksheet and make up your financial statements like the ones in Exhibit 4.7. All right, so we're not going to discuss partial acquisition with control premium, but I did want to talk to you about how we do that without a control premium. If you can do that, you can do it with a control premium.